Welcome to Alpha Wolf Trading. Did you know that there's over 12,000 stocks or companies that trade on the OTC? Between the NASDAQ and the New York Stock Exchange, you have over 7,000 companies. But us as retail investors, we wouldn't know that unless we were researching. Because why? Wall Street focuses on the elite, the big companies. And where the retail investor has their advantage is in small and micro-cap stocks. Why? Because you have the opportunity to speak directly with leadership. That is what this is all about here at Alpha Wolf Trading. We're trying to find the hidden gems, and we interview the executive teams of companies that we think meet the parameters to be those hidden gems. I also want to make sure you understand that this is not a paid-for promotion. I collect no compensation for the interviews I do here. These companies that I interview have been identified as potential opportunities for me and the members of Alpha Wolf Trading to receive a higher than average return on our investment. These companies I have identified either because of a technical setup on a chart, a fundamental change within the organization, new management team, new products, all kinds of different things that actually lead me here. But what do I think is the most important? Leadership. And that is why I do these interviews. I want to understand what drives the person that is leading the charge. I want to feel their passion. I want to understand their vision and the strategy that they're going to use to achieve success. That is what these interviews are for. I want to understand the share structure and the cap table, the size of the TAM, the total addressable market. This is the opportunity to learn all of those things. So sit back and enjoy. And if you learn anything from today's interview, do us a favor. Subscribe to the Alpha Wolf Trading YouTube channel. Hey everybody, Tim from Alpha Wolf Trading coming at you with another CEO interview, new company. Some of you might find this a little odd because I'm not exactly a baby guy, but this one is an interesting story. And Hamutal, when did we originally meet? It's been a while, right?
Yeah,
it's been years. I think it's been a couple of years at least. And I have followed the story, even though this product category is not something that I'm deeply involved in. But there was a couple of things that really stand out for me, and I'm going to go into those in a minute. But I want to first introduce you both, and maybe have each of you give the listeners a little bit of a background on yourselves and how you got here. And a little bit about else, which is BABYF on the OTC markets. But this is a fascinating story. And so one of the things that I loved about this story was Hamutal, tenacious. I call you a warrior I've called you a warrior a few times because that's how you come across to me. You are not someone who is going to just lay down and give up, right? You've had some pretty rough challenges with this business, but you keep growing, and you've been through a pandemic. You've been through supply chain issues, and guess what? You're still growing, and now you're getting to some inflection points. So we'll get to that in a second. But Soki is director, and Hamutal, you are the founder and CEO, right?
I'm one of the co-founders. Yeah, I'm
one of the
one of
co-founders.
them.
But the driving force behind the business, yes?
Yes, I am. I'm one of the driving forces there. I have two other partners, which have been there since we started a long time ago. way before we were listed. And that gives another point of view to the tenacity of this team. So shall I start?
Yeah, absolutely.
Background? Yeah, sure. So all the founders are veterans of the infant nutrition industry. Like, we've seen the ailments of this industry, and we've seen the upsides of this industry, and we always thought there's a change needed in that space, because it is so limited. It is a huge industry that valued at about $100 million so far. But on the other hand, the choices that a consumer has, if they come to a retail shelf, they would see only actually two choices, or even just one, which is a dairy. And dairy has a lot of issues. We don't need to speak to that. So we've always been experiencing issues with consumers that were. I ran the Similac operation here in Israel as part of the Abbott nutrition team, and we always felt that there is a need for an alternative, because we saw how many babies are suffering from allergies and sensitivities and all that type of things. But when it happened to us in the family, to my partner's granddaughter, Uriel, she was severely allergic to dairy. And at that time, we became partners. After I left Abbott, and the other guy left Nestle, and Uri left the private label company that he was working for in the infant nutrition space. And we all became partners here in Israel, running a small company that was doing baby snacks, vegan baby snacks, healthy snacks, and all kinds of other things that related to the baby industry. He had a granddaughter that was very allergic, and she couldn't consume what the market had to offer. And that was dairy-based products that are extensively hydrolyzed to make her body not feel the protein. That's type of products that are the solution, so-called, in this market. They are kind of medical type of products, but they don't work for everybody, and they're super expensive, and the palatability is very low. So it's a very, if you smell it and you taste it, you wouldn't want your baby to have it. But that's the only option that exists in the market if you are allergic, or you are, for whatever reason, you can't consume dairy. And that's quite a big group of babies. Nearly 40% of the categories is catering to those babies. So we had that issue, and we had to solve it somehow, because nothing worked for her. And that's what triggered actually the development of ELSE. So that's my background.
So in case anybody is having a hard time keeping up, this is baby food related product. And as far as I know, I can only think of one huge player in baby food for as long as I can remember, is Gerber, right? I mean, that is the dominant player, has been the dominant player forever, right?
It is, but remember the Gerber's a brand.
Gerber's and Nestle, actually, they were acquired. So
okay, so who owns them now? It's Nestle?
Nestle.
Okay, got it. Okay. But there isn't really any other, I can't think of any other baby food brand out there other than Gerber.
Yeah, baby food would be Gerber, the most prominent one, but probably Similac and Enfamil been there also for quite a bit as infant products, infant formula.
There just hasn't been a whole lot of inventing going on in the baby food space, right?
That's true. That's totally true. It's
just
a very conservative industry.
Right.
Yeah, I mean, the protein sources, which are the most important part of the nutrition, have been there for 120 years. The same protein sources, no changes. The changes are only on all kinds of additives that make it a little bit slightly closer to mother's milk, so-called. No innovation there. No innovation.
All right, and so Keith, so how did you get roped into this field?
I met the company about over 5 years ago now. They were still private when I met them. They were still doing R&D, but the whole vision and what they were doing was just intriguing to me. And what they were doing in that sector, when I looked at the company and did a little bit of due diligence, realized that industry hasn't gone through any changes in over 50, 70 years, really. And then the other thing I had to get my head around was that I was like most people when they said, oh, we're coming up with a solution for infants and toddlers and even children. And to me it was, well, there's tons of brands out there, tons of companies doing this thing. And then what I realized was that, well, yeah, they are, but they're all using the same formulas, milk-based and soy-based. So there's only two formulas on the entire globe, but you have these companies that are using those formulas to come up with products. So what they were looking at doing was coming up with an alternative to milk and soy. To me, that was huge. And I was like, okay, I want to be part of this company. I want to work with them and help them out. And so that was 5 years ago. And I've been working with them. My background is capital markets. I've been in the capital markets for 30 plus years with a international banking firm here in Canada. And left and branched off on my own and been doing projects. And when this project came along, I knew there's a company that I wanted to be involved with. And so I've been working with them for the past 5 years.
So am I right? Is Hamutal a warrior or what?
Yeah, the whole team. It really is a team that, one, they've worked together for a very long time. They come from industry, they understand the sector, and they have a vision. And it's never a straight line. There's always bumps in the road, obviously. And we incurred, many bumps, but the fact that they're driven and they have a vision and they're focused on achieving that. And, the company where it was when we first started to where it is now is night and day. They were still in R&D when I first met them and didn't even have a product.
Than they were 6 months ago.
Yeah, if you look at the evolution the company's gone through over the last 3-4 years, like I said, back, they went public in 2019, didn't have a product. They were just coming out of R&D and developing their first product. First product was launched within, I think, a year of them going public, and it was one SKU, and that's where they started. We started with one SKU into sort of specialty retailers and online. And then they had a very methodical plan to grow the business, grow the product line, and grow the retail and online. And you've seen that happen, but it takes time. It's a process. But if you look at what's happened now over the last 6 months, they've grown, dramatically, particularly on the retail side. It's tripled, more than tripled.
So we're going to talk about that in a second here, but how many product SKUs do you have now? Yeah, you started out with one, it was a hit. Now how many do you have?
Few dozen product SKUs, because we're not selling only in the US. We have, let's say, 10 products in the US and then an additional 10 products in Canada. And then we're now getting into Europe. So additional products for Europe and Australia. So there's few dozens of SKUs that we're selling.
And how about manufacturing?
So just to say that when we started in 2019, we didn't have a manufacturing site. We did some pilots all over the place. Everywhere that could have accepted us, but there's no too many infant grade facilities all over the world. Not to speak about the US, where things are very limited, I think intentionally, and that's why the shortage has happened. So there's only 4 manufacturing sites that belong to the big guys in the US: Abbott, Nestle, Enfamil, and Perrigo, which does all the small brands under private label contracts. So there's no way you can do infant products without having a facility that meets those requirements. We didn't have one, and we had to operate that through COVID. well, COVID started at the beginning of 2020, and we had to find and sign agreements with, with manufacturing sites that wasn't yet an infant grade. We had to prepare them and make them something like that. They were the fifth one in the US, and they wanted to stay cloaked in terms of, being exposed with their names and whatever. And that we started working with them. And that was also a huge challenge to do that. Manufacturing in infant nutrition and spray drying in particular, which is the technologies that we use, is a kind of an art, and every medium behaves differently with the drying process. So, and the drying process makes the product soluble in water, and there are lots of constraints under regulation. So there's these huge things that you need to make sure that are working in that product, and that it takes time. Whenever you develop a new type of formulation for this age, another age, this taste, another country with slightly different regulations, it's the whole story from scratch. Working in the tower, in the spray tower, it's an art, and it's something that nobody knows unless you really, do all those piloting and waste a lot of money on, spend a lot of money on R&D until you get to the 100% product that you're looking for. It's not an easy task. So that's another aspect of this business that nobody realizes until you're really in that business.
And right now, you're in a good place when it comes to manufacturing now, today.
Today, we're in a good place after we had a lot of hiccups with the first facility that had this mechanical issue, and then they had some QA issues. And then we had issues with cost of manufacture. We started with that facility with an X, and that X was tripled within 2 years by that manufacturing site. But imagine that. And you have no alternative. You have to stick to that facility, but your cost of manufacture, which is a substantial part of the cost of goods, is tripled. What do you do with that? So we had to leave that facility, and we did. But it took a long time to bring up to pace the alternative manufacturing sites that we're now working with. It takes a lot of time, a lot of efforts, a lot of money to make them an infant grade facility that meets our requirements. That's why you only have 5 or 4 of them in the entire US. It's not an easy task. It's a very high threshold that you need to meet. And the other things that we did is that we reduced cost of manufacture. We looked for manufacturing sites that could meet that requirement and could work with us to get a proper cost of manufacture, and we got there. Now we have 2 facilities in the US besides the old one that we left, and those 2 ones that one of them we're already working constantly, but there's another one that is going to be dramatically reducing the cost of manufacture for us. It's a slightly different technology, but we've already tested it. We've done some commercial trials, and we at the end of this quarter, we're going to start manufacturing commercially, and the production cost is going to be decreased in 60, even 70%.
Okay, so since we're on this, let's also talk about the fact that you've had tremendous growth in retail stores, like significant growth in retail stores, right? And
correct.
That's really, you're kind of just growing into that right now. You're not fully there. And initially, maybe you can explain how it works when you are going into one of these big box stores, the first orders that come through, and then what you anticipate. The ramp up is going to take time, right? It's not going to be
absolutely
off to the chart.
And we've seen that. We've seen that happen already. When we started working 2 years ago with UNFI and KE, which are the US largest distributors in the natural food space and natural products, we've seen tremendous growth on revenues when we entered those guys, but it took them then about 3-4 months to replenish. Why? Because when you start with a new distributor, retailer, whatever, they get a very heavy discount on the products that get into them. And that's why the first orders are huge. And because this is how they make money, right? They get a big discount and then they live on it for several months, and they start selling and filling up the stores. They also get slotting fees, which are actually paid with goods, with free goods and free fills that we give them. So those things take time to ramp up and to be replenished. And then after a few months, and like 3-4 months from the entrance point when we got to KE and Unify, only then we started seeing repeat orders, the second, third, fourth orders, which were way smaller but very frequent. Like they order on demand and they order by DC, by distribution center. So it's a different behavior of ordering from the second order onwards. It's very different from the first order, which is very big, but it takes time to replenish and
very big and add a discount. So, I mean, what that says is that when things start to normalize, right, your margins are going to come up, right? And yeah, you don't have this huge, massive order, but you've got consistent small orders from a whole lot of locations.
That's exactly what's happening with KE and Unify. And KE became our largest customer until Walmart got in, right? And now Walmart's growing on the account. I mean, Walmart's becoming our largest, but so far KE started from nothing and has been our largest retail customer, servicing a lot of smaller retailers, including Sprouts Farmers Market. And Sprouts Farmers Market is another example of a retailer with 390 doors. Okay, it's not a big retailer. Stores are not big. There are medium, even small size stores compared to Walmart or Winn-Dixie or Giant Eagle or all kinds of retailers, new retailers that we onboarded very recently. And they started from nothing. Okay, we started selling, I don't know, maybe $100 per store in an annual rate. But today, after 2 years, we are selling an average of $3,000 per store in Sprouts. So it takes time to build that velocity. It takes time to build those revenues that are generated by each store. And if you connect the dots on the number of stores that we got in, the additional 10,000 stores that we got into in the recent few months, and you even take only $3,000 per store to be built.
And they're much bigger stores, though. I mean, so you could stay at the 3,000 and stay conservative. But there is probably a pretty good chance that you're going to come in above that 3,000. But I think it's the right thing to do to model it at just the 3,000, right? And then multiply that times the amount of stores. What's your revenue run? What's the run rate look like at that? Do you know? So
I mean, you can do the math. I mean, we're I think around 13,000 doors right now, and still launching into those doors. And by the end of the year, we're projecting that hopefully we'll be closer to 15. So going into next year, I mean, do the math, and it takes time to build that velocity. But let's say going into next year, we built that velocity and we used.
Now, what some people could be concerned about is that because you've had this tremendous growth and additional 10,000 stores, that you might have to ramp up your manufacturing and buy more goods and potentially have more of a cash burn, right?
Absolutely, and you're right, and we didn't stand still when we saw the store counts go up. Now going back 4 or 5 months, as we saw this happening, we also knew that we're going to have to fulfill and put product on the shelf. So we ramped up our production, ramped up our raw material inventories. So we've been doing that for the past 4 or 5 months. So we have now enough inventory to fill those shelves for at least for the foreseeable, few months. And
Exactly.
then when the new production facilities kick in, we'll wrap those up to fill new orders coming in. But what you're going to have is you're going to have an increase in our velocity going up because we went from 3,500 doors to over 12,000 doors, and our manufacturing costs drop by over 50%. So if you do the math going into next year, the company's in probably from that perspective in the best position it's ever been. And yeah, it takes time. We signed up 12,000 doors, doesn't mean we have product on the shelf from 12,000 doors overnight. It takes months to get products onto those shelves and get the velocity going.
What you've most certainly done is shown that there is a need and a want for this product, right?
Absolutely.
Absolutely. The reviews that we're getting both online and through our e-commerce store and Amazon is phenomenal. I mean, parents.
But there's another way to show it. I mean, those big retailers like Walmart and CVS, they started off with us with one SKU, not the entire range, and with a much more narrow number of, or much smaller number of stores when they started off. Like CVS, for example, where now we are in 7,000 stores, over 7,000 stores. We started in 1,000 stores and with a single SKU, and that was in September of 22. Right afterwards, they increased it into additional 4,000 stores with the toddler product, and then additional 7,000 stores with the baby cereal. So that proves that there is a demand to the brand and to the products. Same was with Walmart when we started with about 400 stores with the kids nutritional drinks in September, and before that we were only online on Walmart.com, and then they took us to additional 400 with the kids nutritional drinks, and then after a few months they took us to additional I would say 700 stores, all together a total of 1,100 stores of Walmarts now, with our entire range. So that makes sense. I just rest my case on that. That means that there is a demand for the brand and for the products by those huge retailers.
Right. And so the one thing that I wanted to understand, and we talked about it before we started recording, was the fact, how sticky is the customer, right? And then because it's almost like you've got a built-in exit of your customer because the baby goes from being a baby to, not a baby anymore, right? But you're addressing that because, and you're not seeing people just buy initially for the baby and then just drop off and disappear. You're seeing them continue to buy, right?
Absolutely. This is part of this type of category or business. In the infant space, I think this is the most sticky type of consumption because it's dictated by the baby, actually. The baby, if they like the product, they would stick to that. The mom doesn't have much to do. When they like a product, they just want it. And you can't explain or you can't tell them, listen, this is not existing any longer. And that's why the stickiness is the highest in baby products, and especially in infant nutrition. So we meet the customer first with the baby cereal at 6 months of age, and then they usually use our products when they like it, they continue consuming. But that's a lower price product. The bigger value comes when it comes to the toddler product, where this is it's the main nutrition of the toddler. So they consume it typically they take it 2 or 3 times a day, and then they have to get about 1 to 2 cans per week in order to meet that. It's between 6 to 8 cans per month, and that's stickiness, and that sticks for the next year. It's a lifetime value of about $1,200 per customer in average. Certain are much higher, certain are lower, and then they can continue with us with the same brand that they like and their baby likes to the kids nutrition, and many of them do. So there's the acquisition cost of a customer really is worthwhile having a new customer once he continues with the brand and with all the product range, mainly for a very long period.
And as you get into more and more stores, I mean, because, I would say your brand is probably not real well known right now, but I would say your brand is getting more known every day, right? Would you agree with that?
Yeah, absolutely. I mean, we started off 2 years ago, 2.5 years ago, when we were a no name brand. We were nothing. And we were just selling online, and then we started selling on Amazon. But today, looking at the entire US map, we are in, we're all over the place. We are in 50 states. We have presence in 50 states in the retail footprint. And we are in over 10,000 stores in the US alone. And so I think that's a national brand, and that's national brand awareness. And I think when you go to stores everywhere, all over the place, you meet the products. I haven't seen many brands that started 2 years ago and they have this presence in the US in terms of footprint. It takes much longer to get there. I know that from many people that did brands and that grew brands. So I think we have good brand awareness, and it's only growing.
And I think it's even more impressive that you did it through a really challenging business environment. I mean, the last 24 months for small caps, micro caps has been horrendous. I mean, it's just been a brutal market. It's just been a very tough time. More so for micro caps and small caps than anybody else, because
Correct.
A lot of these companies are established and they can weather a storm, right? You're still growing. You're growing at an amazing clip in a very tough market, and that says one of two things: you either got a really good product, or you have a really good leadership team, or maybe you got both. I think in this instance you have both, right? And I just, in my head, I would have a very difficult time seeing this business not succeed. I mean, it takes time. You've said that a couple of times. It really takes time when it comes to microcaps and small companies, because you guys, you have a lot of challenges, right? The big boys, the hedge funds, they can't mess with you because you're too small, right? They'd have to buy the whole damn company. So really, you're reliant upon the consumer that has tried your product, sees how good your product is, and has a little bit of savviness and says, gee, I think I'm going to buy the stock, right? Because this has really changed our lives. I mean, if you go from having a sick granddaughter to now you don't have a sick granddaughter and she loves the food and she's eating well and healthy, what is that worth? I mean, that's worth something, right? So I think that alone would get people's attention to, if they found out that you were publicly traded, hopefully instead of buying $1,000 pair of Nikes that they don't need, they would buy $1,000 worth of your stock, right? And that could be a life-changing investment. I mean, $1,000 of your stock at this price, it's a good chunk of shares, right? Whereas if you go buy Microsoft or something right now, what do they get? 10 shares? I mean, this is an amazing story, a tenacious leader. And I understand it's not just you, it's the entire team. But I think anybody watching this interview will see that you've got fire in you, and you are definitely a driving force. So good product solves would you call it a significant problem that existed before?
Absolutely.
Okay.
Absolutely. It's a significant problem. We can attest to that with so many testimonials, videos, and thank you letters from so many customers. Some of them just had a small issue, but some of them we were really changing life or even saving lives.
And
It's in our website.
see, those are the things that I love. It's just one of those things. I always, there are things that you want, and then there's things that you need, right? The things that save lives and make people feel better, have a better quality of life, I think those are needs. I don't think those are wants. Those are needs, right? You're saving people's, you're having a real impact. And to me, if more people know about this story, then, you know, I think retail investors forget something. If you look at how many companies have come that who made these companies successful? The consumer. Not all of the consumers, though, bought shares of the stock. They just bought the product, right? And told their friends about the product. And then their friends bought the product. And then but nobody bought the damn stock, right? When you see something like this and you recognize the impact it's having, buy the stock too. Just a little, just a little hint, and be patient. Understand that the stock market, no matter how obvious the story is, it will always take longer for it to be recognized and be rewarded, right? You will be fairly priced at some point. If that's not happening now, all of the accomplishments that you've made over the last several years, you have not been rewarded for those by Wall Street. And you can see that by looking at the chart, right? Anybody can see that. But I would say this, you have been going sideways really since 2022, mid-2022. You're just kind of going sideways. And I call that building a base, trading within a box. That only happens for so long. And I know you just had a quarter. The stock has reacted to some of the press that was in the quarter. People need to understand that, number one, was last quarter. We're moving into the new quarter, right? So what happened last quarter is done. What is forward is what matters. And understanding what happened last quarter is important. So you had a choice. You could either scale back your retail online, or you could risk not ship the big customers that you just got, right? You could say, I'm not going to ship them product because I'm going to take care of the retail online sales first. That would have been a massive mistake had you done that, right? Because the big retail guys are only going to give you one shot. And if you screw up, getting back in is going to be real tough. Would that be a fair statement?
That is so accurate. And more than that, in the infant space, maybe it's different from other spaces of fast-moving consumer goods, but in the infant space, the picture is the picture. It's 75% goes through retailers, brick and mortar. Only 25 goes through online. That's how it is. It may have changed during COVID, so maybe went up to 30%, 70%, but that's how the market behaves. Parents like to buy the products within retailers. That's how they do it. So that's one thing, but it's so correct. It's so accurate. What you said is that we had to take a hard choice. And sometimes that's where you get, life is not that something that you can tell in advance. And we had to take this hard choice, whether to dry out our e-commerce customers, which are individual customers, or to dry out our retail customers, where if you screw up with them, you never get back. It's very difficult to get back to someone like a Walmart or a CVS or anyone like that and tell him, I'm out of stock, I'm sorry, I can't deliver. And then they would let you come back after a few months or whatever. They won't. They just won't mess with you any longer. So I think we made the right decision, although we lost about $3 million in revenues. um, during that time, during those 3 quarters. We did lose them mainly from the e-commerce side, and now we were building, ramping up, and we see the growth trend very, very strongly on Amazon. It's just an algorithm, and we lost certain group of customers, but now there's new customers coming into that space. Toddlers are coming in and out, so that's the way it is, and it's the right decision looking backwards.
Right. So, anybody that's ever been in business, or I mean, look, life in general, is you're going to have hiccups. You're going to have those speed bumps throughout life. I mean, that's just the way it works, right? No one was prepared for COVID. I mean, nobody. And then nobody was prepared for the supply chain issues that came from COVID, right? I mean, there's always going to be things that, as a new business, you're not going to do everything perfectly right. It's just not going to happen that way, right? The question is, are you able to have these things come up and then get through them and be stronger, right? Smarter. And I believe that I agree with you 100%. You made the right choice, right? And it will be easier to rebuild your online sales because let's go back to the product. It solves a need, right? So the customer is going to come back. The online customer will come back. The retail stores, though, they can be brutal. So you made the right choice. So that's last quarter, though, right? And we already talked about the fact that you've already built up inventories, right?
Absolutely. We're sitting on quite a substantial amount of products, but to help us, sell. We don't need to manufacture in the next few months, and we're sitting on about 4 or 5 months of inventory in terms of finished goods, and additional months with raw materials. So we're really sitting on a lot of inventory that was built before.
Isn't going to be what everybody's maybe worried about, seeing that those numbers crank up in the retail stores, because you weren't just looking at that and saying, oh, well, you prepared for that, right? So you've got
we're prepared.
Things.
We're prepared. And the burn rate is going to go down because of that, and because of even in the new manufacturings or the additional manufacturings that will be done towards the end of the year, we will have reduced cost of manufacture. So there's a lot of efficiencies that are taken into consideration here, and that's why the burn rate is going to come down dramatically. We're also cutting a lot of expenses besides that, because we need to get leaner and way more efficient. And now that the market has changed and there's the capability to raise funds is growing a bit more difficult.
That's like saying, I mean, what you just said there, a bit more difficult. I mean, it's horrendous. It is absolutely
it is.
Horrendous. And that's the other challenge that small micro cap companies have in a rising interest rate environment. And that, I guarantee you, is also maybe why the stock has taken this hit off of this last quarter, because if they're thinking that your burn's going to go up and you only have X amount of cash, you're going to be looking at doing a capital raise. And if you have to do a capital raise in this market, you are going to get screwed. I mean, I don't know how else to say it. It's just horrendous. 200% warrant coverage, and sell us shares at 30 or 40% below market. I mean, it's brutal right now. And some of those deals, I understand. What's the alternative? Turn out the lights. I get it. Some of those deals, though, that they're taking, it's the same thing. They're turning out the lights. It's just an extended period of time before it happens. Right. So I'm hopeful that, everybody seems to think we are absolutely 100% going into a recession. I would say we've already been in a recession, and a lot of the indicators that they use to identify a recession aren't the same. We are not back to full employment from pre-COVID in a lot of industries. So there's jobs out there. It may not be your career choice, but if you want a job, I think there's 2 jobs for every person looking for a job. If you want to work, you could work. It's just not going to be your dream job, right? So if that's the case, how does the unemployment number go up, which is what the Fed wants to see? I don't know. I think that's a challenge. I think there are indicators that we have right now that they typically use that they're not going to be able to get what they want by raising interest rates. And hopefully they're going to recognize they're going to do a lot more damage than good if they keep going down that path. I just think it's going to be a big mistake. And, you know, the small microcap space has been getting pounded for 24 months. I believe it was JP Morgan Chase that came out with a report saying that the small caps are the lowest valuation in history. That history is a long time. It's the last time I checked.
Right.
And unless this is the end of the world, which maybe it is, I don't know. I don't think it is, but it could be. Unless it's the end of the world, I think the animal spirit of investors who have been parked on the sidelines, I think for the most part, because they're afraid that that recession is coming. If everybody believes that we're going into a recession, historically, when everybody knows something, the opposite happens. Everybody seems to think we're going into a recession. So I am thinking the opposite is going to happen. And we're going to get a rip your face off, vicious and violent rally. And it's not going to be just a bounce. It's not going to be a dead cat bounce. It's going to be the start of a new bull market. And I think a lot of people are going to get caught flat-footed. And they're not going to be prepared because they're not in the market. There's a lot of money on the sidelines. And it's scared money. And scared money doesn't ever do anything. It just sits there because it's scared. Now, what's going to happen, you get that vicious, violent, because when you do get a rip after going down for an extended period of time, it's always, that is the biggest, that first move is the biggest portion of the move initially. It's like a wow, you know, and everybody says, well, I'm going to wait until it pulls back before I get in. I don't want to chase it. And that's how you watch the next bull market from the sidelines, because you're constantly waiting for it to come back. I think there are a lot of companies out there that are stupidly valued. Are you stronger than you were 6 months ago? I asked that earlier. Are you stronger than you were 12 months ago or 24 months ago? What has the stock done in 24 months? Have you been rewarded for any of the accomplishments that you've made? None.
None of it. None of it is so unfortunate for the investors, but that's how the market behaved.
That is Wall Street. There's two things. They try to scare you out or wear you out. I can't tell you, when I first started, I've been doing this a long time, and I would hold stocks that I believed in for it would seem like forever. And then I would get so disgusted and be like, you know, because I'd see all this other stuff moving and I'd be like, I'm stuck in this thing. It's not going anywhere. All this stuff is moving. So I'd sell. I swear to God, it was like, that was the cue. I sell and the stock takes off on its run that I've been waiting for the last, right? Patience. If the story is good, if nothing fundamentally has changed to the negative, like something really bad, the story is only getting better. Growth is a good thing. Going from 3,000 stores to 15,000 stores is not a bad thing. This is a good thing. And that hiccup that you had between, you know, online and retail, that's going to fix itself, right? But you now have 10,000 more stores.
It's already fixed.
And
it's already fixed in terms of the manufacturing part.
So that's a good thing. Growth is fantastic. You could have no growth and be shrinking. That would be a whole nother problem, right? So you are in a very good place. The stock isn't reflecting that. Uh-oh.
I think we lost her. That's fine. You can continue. I can answer.
I mean, bottom line is, I think that you're stronger than you were. Where do you think
I think the other thing, you're right. I mean, it's night and day in terms of where we were, when we first started, even from, beginning of last year to this year, where we're at. The company is growing dramatically. The stock hasn't reflected that. The market isn't giving us, giving us value for all that. The other thing is that, Tim, what we've talked about in terms of what we've done in the last few years, the biggest, segment of the market that's out there for nutrition in our space, we're still going to be launching into, and that's the ready to drink market, which is massive. It's bigger than it's bigger than the market that we're in currently, and we're getting ready to launch in the next few months a product into that space. In the U.S. alone, it's a $1 billion market.
Oh, hold on, she's back. Hold on, let me get her in here. I thought maybe why is I know why. Hold on. There we go. So you've got new product coming out that's $1 billion market just in the US.
Yeah, that's the ready to drink, which is going to be launched. The other is that, we've been preparing into other markets as well. UK will be launched, and that's a big market. And then we're looking at Australia, and Australia is a strategic market in that it allows us to launch a product for the infant market, which we can't do in the US. But bigger than that is the segue into China. Okay. So, these plans have been in place for the last number of years. It didn't happen overnight. We've been strategically working towards these goals. And what you're seeing now is the rollout of everything that's been going on for the last couple of years. So in terms of the growth and the potential, I think the bigger market in terms of the bigger rollout is still coming. What you've seen is us grow from one SKU into 20 plus SKUs and enter into now really two big markets, obviously US and in Canada. I mean, Canada, we were surprised how fast the products caught on. We were expanding into Canada last year, or latter part of last year, and we thought by end of a year we'd be at around 3,000 plus stores, but we were in 2,500 stores in a matter of months. So we know the product is accepted. We know that the market wants it. It's just time. Before the revenues catch up to what's been going on the store.
I would have to think too, and this is just me thinking, but I said there were two things that really have kept me keeping track of this story. And the fact that there's not a whole lot of players, there hasn't been a whole lot of creativity in the space. And I have to imagine that if you're getting retail's attention, you're getting their attention, right? I mean, somebody's got to be looking at it and going, man, like going from the growth that you have shown in a very short period of time. Hamutal, you said, I don't see too many brands doing the kind of growth in this market environment that you're doing, right? I guarantee you it's not just retail investors that are seeing that growth. I guarantee you're getting the attention of other eyeballs. What do you think? Maybe?
Oh, absolutely. Absolutely. Yeah. I mean, we can't elaborate, but yeah, we're there's no question we're on the radar of everybody out there.
If you're looking from a 50,000 miles standpoint or point of view on the trajectory of this company, you can see the growth that has happened in 2.5 years. And I think it's really tremendous in every scale and in every point of view. And I'm speaking to people that did other brands. It took them 9 years to get to the level of store, to the number of stores that we are located in within 2 years. So there's definitely, it's a different story here. And I think hiccups can happen to everybody, especially if you look at the recent year or 2 years with with a shortage. It happened to companies like Abbott and Mead Johnson, where they had issues with manufacturing. So what did they do? They showed up the entire market. What do you do? It happens to everyone. And I was cut out in the middle, so I wanted to refer to what you were saying about the stock market and the micro cap and people that are just waiting and sitting on the fence and not doing anything with their money. And I'm just looking at just a small investor like Warren Buffett, who always said that when everybody sells, he's buying. That's the right thing to do. And I think else is a huge opportunity in terms of prospects, in terms of where it can get. And that's the right time because it's really undervalued, considering the upside of the FDA and the fact that we are the third option in the entire world for infant nutrition. These things need to be taken into consideration. And if you look at our growth trajectory, putting aside the hiccups, we did well. We did very well in terms of growth. That's all I have to say.
Well, I think that it's true. I mean, you're not saying anything that isn't true. What I like about you is you're very transparent. You're tough as nails. I mean, and I think that is awesome because you need to be. I mean, you are in a it's tough space. Retail in general is a tough space, right? And Wall Street is a tough space. I mean, right now you're on the OTC, and I can tell you how many shares are outstanding. How many total shares are outstanding, fully diluted?
We're issued and outstanding. We're about 114. Fully diluted, we'd be around roughly another 50. Yeah, about 170.
Another how much?
Another roughly 55 million. So call it about 170.
Okay, so just so everybody knows, that's not a bloated share count for a smaller micro cap stock that's growing at the growth rate that you're growing at, right? That's not like some insanely bloated share count. That's like
no, not at all. It's I think at the stage that we're at and the amount of money that's been raised to grow this company, I think it's pretty reasonable.
Right, and if you start to do the math on the numbers, do the math, you start to see a very compelling story here. I mean, I don't know. I don't tell anybody what to do. I don't tell people what to buy or what to sell. But I can tell you this: I don't interview any companies that I don't think are going to eventually make their shareholders money. Right? I can't tell you when. I don't know when Wall Street will get it. I don't know. I mean, I would imagine at some point when you have the wind in your sails, you won't be staying on the OTC exchange. I would think you would be uplisting to a senior exchange, right?
Of course.
Oh yeah, absolutely. We had a game plan from day one, and we're following just like we did on the business side. We have a game plan on the capital market side as well, and we've executed on the first step, which was to uplist onto a senior exchange in Canada, onto the Toronto. So we did that on the TSX, and then from there, when we're ready, we're looking at
and that's if you don't get taken out by one of the big boys, which I hope you don't do. I mean, if you do it, just make sure you get paid well, like really, really well, because I think you're selling too early. You know what I mean? That's what you got to have. You got to have that run first, then you sell. Don't sell down here. Bad idea, right? You got to wait because your story is just getting started, right? I mean, get the scale, then get the appreciation from the stock perspective, and then maybe you can have a conversation.
Absolutely, we're not anxious to sell. The company is just still has a long way to go. We think it's extremely in our opinion, it's extremely undervalued from in terms of the growth that we've shown over the last 2 years. But having said that, you're not far off. I think we are on the radars of many other companies out there that are watching us. So we'll see where it goes.
All right. Well, like I said, don't sell now. Go ahead, Hamutal. What were you going to say?
I think I've said all I had to say.
All right. So listen, this is what I would like to do. I mean, from a technical standpoint, this is what I would say. The stock is testing an area of potential support that goes back to 2020, back when you, I guess, initially uplisted, right, to the exchange, right?
Yeah, we're back. The stock's done a full circle, I guess you could call it.
Right.
We're back.
So the high was in $4 range, right? The 50 and 200 day are doing some interesting dance right now. You just had a golden cross. That's like a bullish signal. There's a lot of things going on here. You're at an area of potential support. You are growing. You just had a quarter that was, okay, there was a hiccup, but that's behind you now. And you have all kinds of good stuff coming up because you have plenty of inventory and you have a new manufacturer that's going to reduce costs by, I think you said 50%. So those are positives that are coming up. Forget about the negatives that were back there because we're moving forward. So I have to ask myself, what is the risk reward here? I could lose 38 cents. It could go to zero. And that's if you go out of business. I don't think you're going to go out of business after you just landed 10,000 more stores. That doesn't equate to me. So my guess would be my risk is 38 cents. My upside, the very first area of real defined resistance is around $1, is where I see the real defined resistance because it stayed on top of $1 for a long period of time. And then when it finally broke. So now that I think is your biggest resistance point to the upside, right? And it's always is for penny stocks because you're no longer a penny stock when you get over $1. So I would say this is a fantastic time to start building a position. Am I telling anybody to go all in? No. But put the stock on your radar, pay attention, go to the website, sign up for investor relations, email alerts, pay attention to what's going on with the company, right? And if you took a starter position here, the next area to potentially add would be somewhere around 25 cents or so, right around there. That would be all-time lows. Yeah, I think your risk reward at these levels is fantastic, right? When the things start to come into place with that share count of 100, I mean, that's nothing. That's 150 million shares. I mean, that's nothing. One fund could buy 150 million shares in a heartbeat, right? I mean, that's nothing. When good news happens, this thing could move. What I would like to do is let's revisit after the next quarter. What do you think? We'll do a follow-up, or if anything, how about this? If anything significant that you think is new, worthy of discussing, we'll have you for a follow-up. If nothing happens between that and the next quarter, we'll do the next quarter, right? Sound good?
Great.
No, sounds great.
All right. Yeah. Listen, I want to thank you both for taking the time to come in and share the story. And I just know you're going to be successful. It's just patience, right? Okay.
Thank you.
All right.
Thank you so
Tim.
much, Tim.
Appreciate
Thank
it.
you for having us.
Hold on one second. I'm gonna turn this off. Hold on. Thank you for tuning in to another CEO interview here at Alpha Wolf Trading. Today we had CEO Hamutal Cohen Yitzhak and Director Soki Puag from Else Nutrition, ticker symbol BABYF, as in Frank. I hope you enjoyed today's interview, and if you did, do us a favor,
give us a like. How about giving us a share? And while you're at it, why not give us a follow? Until next time, stay safe. Alpha Wolf Trading wishes you the very best of success.